If you're investing through regulation crowdfunding, you're participating in a very specific deal environment. Reg CF is structured, accessible, and regulated, but the risk profile is not small. The right approach to treat Reg CF as a venture-style allocation with disciplined screening. Let's start with the non-negotiables of the Reg CF rule set. A company can raise a maximum aggregate amount of $5 million in a 12-month period under Reg CF. The offering must be conducted online through an SEC-registered intermediary, either a broker-dealer or a FINRA-approved funding portal. There are investor limits for non-accredited investors across all Reg CF offerings in a 12-month period, and there is generally a 1-year restriction on resale of crowdfunding securities. Those three facts define a deal environment. This is broad distribution, this is limited liquidity, this is disclosure-based investing. Now, what do sophisticated investors actually look at in a Reg CF deal? I'm going to give you 8 screens. Screen 1, the security type. Is it common equity, preferred equity, a convertible note, a safe, or something else? You're not just buying into a company. You're buying a specific claim on future economics. Screen 2, valuation and dilution. If the valuation is high relative to traction, investors face long odds. A strong Reg CF investor asks, what is the implied valuation? What future rounds are likely? How will dilution impact my ownership? Screen 3, use of proceeds. Reg CF is disclosure driven. If the use of proceeds is vague, that is a credibility problem. A strong use of proceeds explanation is specific and measurable. Screen 4, financial condition. Even if you are not an accountant, you can still ask, is revenue growing? Are margins improving or deteriorating? What's the burn rate? How many months of runway exists after the raise? Screen 5, concentration risk. If one customer, one channel, or one supplier controls most of the company's revenue or delivery, investors have concentrated risk. Screen 6, governance and communication posture. Reg CF investors do not get the same control rights as institutions, so you must price governance risk. The best signal here is whether management communicates clearly and consistently, and whether they address risk without spinning. Screen 7, cap table complexity. Crowdfunding can expand the number of shareholders. Investors should look for signs that the issuer understands cap table administration and future fundraising constraints. Screen 8, the exit logic. Reg CF securities are not automatically liquid. Investors should ask, is the exit plan acquisition-focused, dividend-focused, or a future public market plan? Now let's tie this back to data availability. The SEC publishes Reg CF datasets and updates them quarterly, which supports investor research on the market overall and can help investors build pattern recognition around offering structures and issuer behavior. And the SEC's DARA has published analysis of the Reg CF market covering 2016 to 2024, which signals that the regulator sees this market as large enough to analyze as a capital formation channel. Here's the key takeaway. Reg CF can be a legitimate way for investors to access private company exposure, but only if investors apply disciplined screens. Most Reg CF investments should be treated as high-risk, long-hold positions. If an investor wants the liquidity, Reg CF is structurally not built for that. The win condition is not short-term price movement. The win condition is long-term enterprise value growth.